Hi, everyone. Welcome to another edition of Wallet Max Planet Positive podcast. I'm Bhuva Shakti, based in New York, and the founder of Wallet Max. We are a global community of startups, investors, and executives focused on increasing sustainable funding access, especially in climate tech, fintech, deep tech, and AI sectors. We interview one investor every month for our podcast. We invite them to share their background, but more importantly, what differentiates them from the crowd. How do they prioritize impact along with profits and people? We deep dive into their personal and professional journeys and their mission to uplift. Today, we are speaking with Virginie Raphael, the founder and managing partner of FullCircle. Virginie is investing at the intersection of human purpose and potential. She is obsessed with serving founders at the earliest stages and passionate about finding ways to better align founders and funders. Prior to founding Full Circle, Virginie was a managing director at Tusk Ventures, where she was an early employee and spent 8 years advising and investing in early stage founders operating in highly regulated industries. Before Tusk, Virginie honed her analytical and financial skills as a banker at Lehman Brothers and Barclays. Let me now hand over to Virginie and invite her to say a few words about her background and career path. Over to you, Virginie.
Thank you so much for having me. I'm very excited to be on the podcast. Yes, I'm also based in New York, where it's finally finally warm, so we're happy about that. I'm excited to talk about my journey and how we look to make an impact by having a very outcome driven thesis, which is pretty unique. So always appreciate the chance to say more about that, so that we can see all of the brilliant founders building amazing companies that are really going to create amazing path for people to come into the workforce, into jobs that they otherwise would have never imagined, or be able to remain in the workforce in a job that they already have and love. So that's our focus, and I'm very excited to talk about any and all of that.
Thank you so much for joining us. Mission driven is kind of coming up with so many conversations these days. But then you started in banking, especially investment banks, Lehman Brothers, Barclays, and later moved into venture. So, what was that pivotal moment that changed how you thought about work, capital, and entrepreneurship?
There were many arcs in that story and many inflection points. And truly, this is why I named the fund Full Circle, because I felt like I had come into a point in my career where I could put all the pieces together and finally come full circle on that journey. And so, yes, you're right. I started in banking. That was after wanting to work in government because I thought
Mm,
impact needed to start in government, and this was going to be the place where I could have the most amount of impact on the most amount of people possible. And then I spent a little bit of time in government and figured out that, whoops, maybe it wasn't really for me, and it was not going to be nearly as fast as I needed it to be. So banking was my way, or my first bridge there. Of I was in public finance at Lehman, which means issuing bonds for state and local government to help them fund schools and parks and roads. And so in my mind, it made a decent amount of sense and helped me bridge that need to be in the private sector and yet work with state and local government, not in government necessarily. So that was the first step. After that, I was recruited to work at a consulting firm, Tusk Strategies, as you mentioned. And the goal there was regulatory and political consulting. So yet a step closer to that public policy government angle that I wanted to have as a career arc. And then completely serendipitously, we had connections in the Bloomberg administration. And one day they called us and said, there's a very brilliant entrepreneur who's very insistent on putting black cars all over the streets of New York City, and that's just not how it works. Will you please work with him and explain to him that he needs to have a strategy in place if he wants to put his product on the streets of New York? And so we started. That was Travis Kalanick at Uber. We started working with Travis, and for better alignment, Travis offered to for us to take some amount of our retainer in equity. That was the very first time I had ever seen a term sheet for to take equity in a pre-IPO company. But that was my first foray into venture. Of course, I didn't think about it at the time, but that is how the company that I was at, Tusk, became a venture fund. And so I learned everything that I know about venture by as often, learning everything from the ground up and building a fund from the ground up. And there was no better training journey from A to Z on fundraising, fund administration, investor relations, diligence, the investment part of it. And so that was the journey into venture for me until I started my own fund mid 2021, which I'm sure we'll talk about as well.
Yeah, no, definitely. And I also was consulting for Lehman Brothers early 2000 up until 2008, and was part of the M&A with Barclays Capital. So yeah, I understand how that space works. I was on the investment banking side. So
Mhm.
it's a good journey for you from that into venture capital and investing, because there are some things you wanted to do, but then government was not the fastest thing that you could piggyback on for your journey, right?
Exactly,
Now,
exactly.
Now, you've spent years backing founders in highly regulated industries, especially also be it government, investment banking, or venture capital. There is a lot of regulation. So, what's your unique secret sauce when evaluating companies operating in complex environments? Especially some people don't like regulations, but then they are sometimes good for your business. So, how do you balance that? What's your secret sauce?
Yes. So there's two angles on this. There are some sectors where this could be a contrarian take, but where the founder not having industry experience is actually beneficial. So
Mm,
funds might look often for if you're building in whatever space, have experience in that space and how deep is that knowledge in the space. I think there are sectors like healthcare, for example, that are so infinitely broken that a founder that has a completely outside perspective on it, a completely will come in it, think of it from a first principles mindset, can actually create something a lot more valuable by not having been, jaded for a lot of lack of a better word, by having spent years and years in the system. And so sometimes I look at the founder a little bit different as like, do they know something that people in the system, currently ingrained in the system, may not know, may not see? Do they have a very different business model, for example, that they can bring to the table? So that's one way of considering founders that are building in very complex regulated industries like this. The second lens is you do need founders to understand that just because they're not particularly interested in politics or regulations or it doesn't mean that regulators won't take an interest in you. That's something that
yeah.
definitely learned at Tusk. And so there are some companies where early on it's a matter of keeping them out of the regulatory considerations or out of the regulatory radar, if you will. And that comes from how do they talk about the company? What is the positioning? Is this a savings product or is this an insurance product? I learned a ton from really understanding, well, if we wanted to be positioned in that way and not face some competition from being seen as something we're not, here is how we should think about branding, marketing, the product, right? The interactions, how we talk about it. And so that has stayed with me and often gets me onto cap tables, either because the founders find me myself for this experience that I have, or because other VCs know the market, love the team, love the product, but they don't have a really good sense of how to evaluate that regulatory risk. And so they'll come to me and say, hey, I love everything about this company, but I have no idea how to mitigate that regulatory risk or how to evaluate it even. Like, can you help and take a look? And so sometimes that will lead me to have some opportunities that I otherwise wouldn't have, which is, of course, fantastic.
Yeah, no, very unique perspective where sometimes investors always look for founders with some experience in that area that they're trying to launch something. But in sectors that are already broken, you need a fresh perspective, a new perspective from outside in to try to innovate, right?
Yes.
Now, now before founding Full Circle, you were an early employee at Tusk Ventures, right? So now you founded Full Circle, so you're a founder yourself in many ways, right? So what did that experience from Tusk teach you about founder resilience, the founders that you are investing in, and as a founder yourself to navigate systems that were never designed for innovation?
Yes. I think I spend a lot of time on business models for that reason.
Mm,
Because so when I was at Tusk, there's always waves in innovation, right? And so COVID hit, the beginning of COVID hit, and leading up to that, there was a lot of innovation coming from telehealth, right? And so that
mm,
was good in and of itself. Like that enabled people to have access to care when we were otherwise in a virtual first environment. It definitely opened up more access, right? Because it was easier if you didn't have to drive an hour away to see a provider. Obviously, that was helpful, right? The telehealth innovation in itself was helpful. But we, in that period of time, we didn't fundamentally change the care delivery model. It was a one to one, right? Like one provider to one patient over the span of an hour. Yes, they were meeting on Zoom and that was helpful. But other than that, there was still some massive opportunity that didn't get unlocked because it wasn't as scalable as fundamentally changing the delivery model and the supply that came into the market, right? So I
Yeah,
carry that with me, and I have a keen eye for founders who think about business model and the way to really scale their model in a completely different way. And I'll give you an example to illustrate if I can. I'm an investor in a company called Soul Health. And what Soul Health came to me with was, look, mental health is one of those spaces where the more demand we uncover, the more supply of providers we're going to need. And we will never really satisfy the demand because the more you uncover demand, the more comes, right? And the more you make it
yeah,
accessible and affordable, the more demand you generate, right? And that's the correct insight, I think. The way they wanted to tackle it, therefore, is on the supply side. And they said, look, we're losing a lot of therapists because it's a very hard job because their workload has increased so much. But nobody's really looking at the therapist in training, right? All those young people
mm,
who go to school who are currently trying really hard to get their clinical hours to reach licensure. So they said, we really want to focus on therapists in training. We'll put them under the supervision of a supervisor. They will be able to deliver culturally competent, much more affordable therapy because if they take cash pay as a non fully licensed therapist, it will actually be cheaper for them to take Medicaid than it would be to take cash pay. And to me, that
yeah,
was very sort of like a very, as we were talking about before, right? Very first principle, very fresh way of looking at a space that had a true supply constrained market where we needed to create that supply. But the business model was fundamental to opening up truly more supply in a meaningful way, right? By tapping into a net new group of therapists and also offering the care under a brand new business model. Where when I was investing at Tusk on digital health solutions, often to make the unit economics work, we needed to consider cash pay, and commercial insurance only was not possible for the company to have, not if we
yeah.
wanted it to become a big profitable business. And so that shift in model was really intriguing to me, to bring net new supply to the market and at a cost that was affordable for patients. So that was quite a powerful change in the business model. And so those are the type of things that I look for with a lens toward what did you take from your prior experience, but that would be a great example of that.
Yeah, I mean, focusing on business model and ensuring it's scalable only kind of ensures that it's a robust business and the model is sustainable, long term, and so on and so forth. And great example, mental health is also very close to my heart. And many people talk about how can we get more care to the patients, but then there is shortage of good quality therapists. There are a lot of therapists, but then good quality therapists. I mean, even therapists have to see therapists, and how do we
Yes.
make them productive so that they are able to provide the necessary care? So, yeah, focusing on that has been a great thing for you, I think. And at Full Circle, you invest at the intersection of human purpose and potential. So, first, I want to understand for our audience, what do you define as human purpose? And then, what does that actually mean from paper to practice from an investor lens?
Yes. I love that question. So we think of it on an axis almost, right? So if you have purpose as doing the things that really drive you as an individual, that really interest you, that you're perhaps really good at as a child, with that as the top of the y-axis, and of course economic opportunity, right? Because this is a job we're working on finding you that is appropriate for you to feel, of course, fulfilled, right? But you also need, this is a job, you also need to fulfill your economic needs. So that's one
Yeah,
axis. And then we always think about going from individual to collective. And so across sort of that axis, there's the personal fulfillment quadrant, where it's a lot about health and financial agency. It's a lot about consumer health and learning. We're really in a phase where people are really trying to understand what it is that they need, and we are capable of offering a level of personalization that matches everybody's need for fulfillment, but also agency in a big way. On the other side of that, right, we want to build some systems that are inclusive and equitable. And so we think a lot about workforce reentry, workforce retention, talent pipeline development. That would be the other side of that purpose fulfillment, but almost like more collectively than on the individual level. And then if we go to the bottom of that matrix, from an economic opportunity standpoint, the more fulfilling your potential, right? From an economic potential standpoint, same thing there. On the individual side of things, it would be more about economic independence, whether that's entrepreneurship, self-employment, helping people have a lot more flexible work models. We think of it as really satisfying the need for having the mode of work that suits you best at any point in time in your career. And we know it's going to change, right? Because people are going to
Yeah.
become parents or caregivers or whatever the situation is. So having everyone in the mode of work that suits them best and fulfills their economic needs is important. And then the last quadrant would be about this idea of transforming work models. So that's collectively the businesses are changing. We think about aligned business models, like we just gave an example of. We think about the fractionalization of work, where
Yeah.
now, especially with AI, I'm sure we'll talk about that, going through a massive rethinking of how professional services are delivered, how we measure the unit of value creation down to a very, very small granular component. And so that means that we need to rethink collectively how we unleash that economic opportunity. So that should give you a little bit more of a bucketing approach to some of the things that we look at across that sort of purpose and economic opportunity.
Yeah, no, I've heard quite a few times that if you do what you love, you're not actually working, but you're still having that economic opportunity for you and your family and whoever you have dependent on. Now, several years back, I heard a lot of innovation in edtech. Then, since the pandemic, I'm seeing a lot of innovation in care economy. It's
Mhm.
becoming very much a focus for folks these days. But I also see you focus a lot on work tech, right? So,
Mhm.
why did you choose edtech, care economy, and work tech specifically for your investments?
So we wanted to. It's interesting that you're picking up on those three categories specifically because for us the main goal at a very high level was to not have a category based approach, right? We thought
Mm,
if we rather than describing the categories in which we invest, which could be limiting, why don't we describe the outcome that we want to drive such that founders can come to us and say like, well, I'm driving that outcome. I would love to tell you what we're building. If it's a healthcare
mm,
company, if it's a manufacturing company, if it's a supply chain company, like that can all be investable by full circle as long as the outcome is we are either creating structural change in the workforce and putting a net new worker into a job full of economic mobility for them, where they will have pride and agency over what they're doing. And ideally, it will align with their values and certainly fulfill their economic needs. Or do we prevent someone from dropping out of the workforce, not out of choice, often out of necessity? Right. I don't believe that in a country like the US in the year 2026, we should still have parents who make the choice between dumping all of their paychecks onto childcare or staying home with their children. Right? That is fundamentally
yeah.
not a choice a lot of people have. There's 53 million caregivers in the US. And so we really wanted to capture that whole spectrum by just saying, this is the outcome we want to drive. We're not category investors, we're not thematic investors because all those themes can change, and we're seeing it now with AI. And so rather than describing the work that we do by investing in categories, we just prefer to say, this is the world the way we want to see it. We want to invest in the world we want to see. And so if we can push us forward toward that world and to just talk to us and we might be willing to invest. So that's the lens we take. I don't know if that answers your question, but that's our framing.
Yeah, yeah, no, that's perfect. So instead of doing categories or industries or sectors, if the outcomes are driven by any innovation that falls under any category, doesn't matter. As long as the outcome is there, then it's investable, right?
Yes.
Now, you also often talk about aligning founders and funders better. People always talk about product market fit, founder market fit, right? But investor founder fit is not something a lot of people talk about because founders are just trying to get that check from that investor. And the investors, once they give the check, they are just focused on generating ROI for their LPs and then exiting if need be in that certain time frame.
Mhm.
Now, where do you think that relationship breaks down most today? Is it in the pre fundraising? Is it when the check is handed over? Is it the post? Where does it break, and how can we fix that or maybe try to do something about it?
And we could spend the entire time we have together on that one question because I think the answer is all of the above. And so Pre a few points. Pre-fundraising, I think there is a lot of time being wasted by founders talking to investors who are not aligned with what they're doing. And by that, I mean in a very broad sense of the word aligned. Um, they're not stage aligned. They're not thematically
Mm,
aligned. They're not, there's a little bit of a and this could be a contrarian view, but I don't believe that fundraising is a numbers game. I don't believe that
yeah,
there is anything to be particularly proud about slipping your founders a list of 100 investors that you can introduce them to. This is not the founder's job. Like often they don't know how large those funds are, whether they're actively deploying, what type of check size they're cutting, why they would be interested in this particular company at this particular time built by this particular founder. That's my job, right? Like if I know my companies well and I know my founders intimately, I will be able to make a handful of introductions. And by that, I mean a handful. Sometimes I make five, but two or three of them convert and the round is done and they can go back to building. I think
yeah,
that's the true value of an investor and true alignment should be found prior to even reaching out to investors. I think other ways in which the misalignment starts to become evident is timeline and then economic
mm,
incentives, right? So if you have a fund that is writing a check that is the last check out of their first fund and they're currently raising for their second fund, just say, the founders should ask themselves a variety of questions like, well, how much of the manager's time am I going to receive if they are moving on to fund two and we're getting ready to fund a whole other set of companies? Um, there's often because of the fundraising cycles that fund managers have on the other side, there's often a lack of understanding. I think that founders should have better clarity on, again, for alignment purposes, in terms of where the manager's time is going to be spent. And if a manager is going from a non-performing fund to raising a new one so that they have another shot on goal, the answer is they're not going to spend a lot of time with that founder. And I think that's a terrible misalignment of incentive. And then economically, I think that it's more of a maturity timeline perspective. We hear a lot about power law and venture and the fact that one company can return the fund multiple times over. Look, we're subject to it just like any other fund, but the fact that we're structured as a permanent fund gives us a little bit of a different view in terms of when it makes sense to exit. We don't look to drive marks for investors. We don't look to fire sell just because it's coming to the end of our fund cycle. We're truly aligned in the long term with our founders. If it takes 3 or 4 years for a company to reach HAPA scale and be very successful, amazing. But if it takes a little bit longer, that's fine too. And I think the idea that we're completely mismatching the maturity and the timeline of those funds to the time that it sometimes take to unlock true value in a company, especially when you invest at pre-seed. We just
yeah,
started asking ourselves the question of, does it make sense to have a 10-year fund, or is there a different time horizon and a bit of a different structuring that would make more sense for being a true pre-seed investor and aligning ourselves with the founders? So that's how we thought about it, and that's the origin story of me starting to go deep down the rabbit hole in terms of other alternative fund structure to the 10-year, 2 and 20 structure that currently exists in venture for the most part.
yeah, and it's benefiting both you and your founders, right? Using this perpetual fund structure than the traditional model might have been different to build or might be unconventional, but then it's really helpful for both you and your founders, and that's majority of alignment that we are looking for.
100%. And by you, you mean full circle and my investors, right? That's
Yes.
important. Like I as a manager win only when my founders make money and when my investors make money, and that was really important to me. And so the idea of full circle being only one fund over time, the true key component to this is that we're fundamentally structured just like the founders that we back are structured. We have a cap table. We have 28 investors who came in for that first tranche or first fundraising round, depending on how you want to think about it. I'm a founder myself, like you said earlier. That's very true. And then over time, we'll keep adding capital to that one entity, but everyone will have exposure to everything that's in the fund at any point in time. And so to me, that helps create alignment in terms of none of my investors have to worry about, well, are you spending time with fund one companies? And how about fund two? Because I only
Perfect.
invested in fund two, but not fund one. And like that creates all sorts of questions that are, for us, non existent, right? I manage everyone's capital. It's one cap table and we're all rowing in the same direction. It's hard enough to build companies at this stage, let alone when you sort of have different priorities and different incentives than the founders that you back. So, what that enables us to do, and we'll get to that in a moment, is really to provide transparent advice to the founders. They don't have this question at the back of their mind of, well, Ms. Virginie tell me that because she's in the process of raising the next fund. And so that's what she needs. She needs a mark and she needs me to fundraise and she needs me to take more money. Or is she telling me that because she truly believes that that's what's good for the business? And 100% of the time, it is because I believe that that's what's the best for the business because I don't win when they don't win and my investors win. So it's very simple. And that was really important for us to do that from day one.
Yeah, exactly. And like you rightly mentioned, sometimes founders are trying to, blast out generic emails to thousands of investors without knowing, number one, are they their ideal investors, or are they even deploying capital, or are they in a different fundraising cycle than them,
Yep.
right? So those are a lot of mistakes that founders could save time on early in their cycle so that they meet the right founders. I call it the ideal investor profile, like how you
Yes.
ideal customer profile, right? Now,
Same.
founders typically make a lot of mistakes when raising capital. One of the goals of our discussion today is also to say, okay, what are some things you can avoid so you can little bit fast track your journey, right? So that's what we are also trying to do here. Especially if you're a founder building mission driven company,
Mhm.
then the challenge is much higher. There could be more mistakes, more time taken, more challenges trying to raise capital. It may look like you're close to closing the funding round, but it may never close, right? So, from your perspective, what are most common mistakes founders make, especially if they are building a mission driven company
Mhm.
when they're raising capital?
I would say a few things. One is raising too early, or
Mm,
going out too early. Um, it's good to build relationship, yes, especially if you do the job that we were describing just a moment ago of have the right pipeline, right? It's a sales job. You're right. I like this term of ICP for founders. Your job is you're not going to sell your product to someone who's completely uninterested in it. It's the same thing. You're not going to go pitch your
yeah,
company to someone you know is completely uninterested in what you're doing for whatever reason.
yeah,
And so
yeah,
that pre-work is important. So going out too early and building relationship though has its limits because often you need to think about, look, an investor's job, right, is to make money for their investors. You said that earlier. That's exactly right. So my job is to de-risk the investments that I make as much as possible. And you know what's really good at
yeah,
de-risking investments? Time and data. And so, if I see a founder that is a little bit too early or coming out too early, and only raising 6 months from now, I'll say, great, I'll take great notes. I will, and it's not hard to do right now. We all have our granola running and whatever else. I will make good notes in terms of where you say that you thought you would be. And 6 months from now, I'll be like, okay, so how is that ARR target going? Like, did you reach your milestone? Did you do X, Y, Z? Right. So it's leverage that you're losing if you give out too much information too early. There's a huge information asymmetry, right? Game happening when you're fundraising. So that's one. I think not having a detailed use of fund and a very clear use for the
yeah,
capital is another mistake that founders do often. Investors are looking for really good uses of their capital, right? It's a very equity is very expensive piece of capital. I don't want my capital to be used for marketing. I don't want my capital to just be used for payroll. Like those are sort of uninspiring at best use of capital. I want to know that my capital is going to be turned into multiple of what it is right now, right? And so if that's true,
yeah.
I need to see that the founder has good uses for it in a way that will enable the company to grow multiple times over where it is now. And so what I don't like often is founders who come to me and say, well, we're raising 1 to 2 million. Like, you know the difference between 1 and 2? It's double, right? It's 100%.
Yeah,
It's a big difference. Like, I wanna know what you can do with 1, what you can do with 2, and it's okay to have a plan where it's like, "Well, if I can only raise 750 now, here's what I'm gonna do," versus raising 1.5 now. Like, that's a little bit of a different positioning than saying, you know, "I'm raising 1 to 2," or a range. I think that's another thing I see often that is a red flag.
yeah,
And then the other one I'll say would be being too attached to a particular valuation.
yeah,
I think some founders are trying to generate a sense of urgency. Sometimes they set the terms themselves, or they take some terms from angels that are completely unworkable for investors who are more institutional in nature. Often I think you need to understand that the market will set the terms of lead investor if you have one. Not that you should need one for a 1.5 million pre-seed. We can talk about that, but often making the mistake to just be too married to a number and evaluation without understanding what that means and that you'll need to grow into that number. Often within a short period of time, can be quite damaging to a fundraising process. You can lose momentum really quickly by doing any of those things.
yeah. I know. So true. So sometimes founders are thinking about, okay, only when I raise capital, I can build the product, I can expand, I can scale. But then on the other hand, investors want to see some traction so they can fund to scale, right? So there's a big mismatch there. And also, like you rightly said, valuation. Market many times trumps what we try to say as valuation. But if it's a good investment, especially if the investors are going to be helpful not just in giving the check but in your journey of achieving milestones, then probably you should try to rethink the valuation and talk a little bit more set of investors, right? Yeah,
Yes, and I would say, it's a prioritization, issue, and so you always need to put yourself in the shoes of the person you're talking to.
yeah,
For me, I try to bucket, the founders that I talk to every day, right? So is this a founder who's, like, has already closed some capital, has a really clear use of funds, and is only raising the last, 250 on the round that's, like, already 80% closed, versus a founder who's like, "Well, we're raising 2 to 3, and our expectation will be in the 20 to 25 million dollar valuation range." I'm more likely to just be like, "Okay, well, come back to me when you have some terms that I can actually look at." And then you sort of like you wasted your opportunity to like meaningfully engage an investor just because if you've set some terms that are just completely outside of my target range, which I is on my website. You can find that if you do a little bit of research before
yeah,
talking to me. That's a big mistake that often I see. That is like, just don't pretend you read my thesis. Like I have a website, I'm very easy to find. Like just do your research. That's
yeah,
sort of strike number one. And so if you know that, and if you know that my preferred valuation is around 10 million, and you come to me saying you're hoping to raise at 20, like I'm not going to pay a lot of attention, right? You're way outside of my range. You saying that you're flexible for the right partner is just not going to help me all that much. To be fully
yeah,
transparent. So
yeah. You need to build that relationship, and let's say even after a lot of diligence discussions and negotiations, you are not the right founder investor fit. You need to maintain that relationship so that you can continue maybe at a future round or something of that sort, right? So I
never
think
close
that's one
doors.
of the things. You never close doors. Yeah,
Yeah, you'd be surprised the notes back that I send when I pass on an opportunity. Yeah, some are very gracious and some are very um less so. So, yeah, don't close doors. It's a small world, people talk. If you get a
mm,
no, I get it. It's disappointing. You've invested a lot of time. But always be gracious and say, thanks for the feedback. I learned XYZ or I heard XYZ and I'm grateful for the time we spent. You never know, right? That investor might decide that if the note back that you receive, they might decide to make an intro, be like, it's not a fit for me for whatever reason, but like I was really impressed by the founder and the response that they gave me when I delivered the no. There's no harm in keeping all doors open at all times and being a good recipient of feedback, and action on it. I've said no to founders 2 or 3 times before I said yes. And so it's a real, live example and it happens a lot. So you'd be surprised what type of responses I get sometimes, and it's not the right type of response to give to an investor ever.
yeah, I know. I mean, it's a small world. People talk to each other, and also like how you are shopping for investors. Investors also want to learn more about you, and they don't want to hear something contradicting what you are trying to propose in the proposal, right? So, yeah, don't burn bridges.
Yes.
Now, you have a perpetual fund, and we've spoken quite a bit about that, how it kind of helps both your founders and your investors. You're kind of in the middle, helping win-win for both of them, right?
Yes.
Now, how does this help you evaluate success for both of them beyond the traditional funds? Should it be evaluated any different, or how does it work?
No, so it's a 5-year commitment period, so you can put 2 peers together and benchmark it against a 10-year fund if you must.
Mm,
No, otherwise, it's a very clean pre-seed strategy. The construction model is to invest in 30 to 40 companies per cycle. We do not follow on, so it's a clean, no follow on pre-seed strategy, which continues to drive that alignment, right? Of once I'm in,
mm.
I'm in. There's no signaling risk associated with taking a full circle check. If I do an investor reference and the question is, well, are you investing in this round? The answer can really quickly be no, but I never am. So this is not a sign of anything other than that's not my strategy. So we try to keep things very simple and very consistent. And that's really our true advantage in terms of getting access to the very best founders who value transparent partners who will be on their side no matter what and are fully aligned with them economically.
Yeah, and early on in the pre-seed itself, right? So that's really an advantage.
Correct. Yeah.
Yeah. Mhm. Now, globally, so many things are happening, but especially the workforce systems are under a lot of pressure. Number one, automation. AI, is it disrupting, helping? Not sure. People are burnt out, especially it has been continuing since the pandemic, and I don't think we've gone back to fixing that. Caregiving, we spoke about it. Caregiving, parents, kids, seniors. There are so many caregiving challenges. Where do you see the biggest opportunities emerging with so much under pressure in the workforce systems?
Yes. I have two lenses on this. One is to look where there is still and will for the foreseeable future be massive labor shortages, right? So,
Mm,
care, we've already talked about healthcare. Uh, yes, is there going to be some amount of robots that will be able to keep company to the older adults? And is there some automation like ambient scribing that can enable providers to provide better care assisted by AI? Yes, absolutely. Do I believe that we're not going to need humans to take care of other humans over the next 10, 15, 20 years, even? Absolutely not, right? And so that's why we've over-indexed quite a bit on workforce development in the healthcare sectors, especially. There are other areas where we invest in a company called Skillmaker out of North Carolina. And what they do is they train auto technicians. And same thing there,
mm,
right? Like same argument. Like at some point, won't the robots fix all cars of all year, of all models, EV or not? Yes, maybe. In the meantime, you and I need to get our cars fixed if something happens to it, right? And so I'm a
yeah.
huge believer in there's a huge shortage of technicians in the US. Those are great jobs. If you can learn how to fix a car and do a good job, like you can make a lot of money. And so I'm focusing on those opportunities that AI, by the way, has massively enabled to scale a lot faster because content production is done in like 3 minutes. Content ingestion is like this now when it used to be a lot more expensive. And so I'm
Yeah.
really interested in backing solutions where labor shortages are going to remain. And then the second sort of lens on that question is geographic. And so
Mm,
yes, the AI narrative of huge disruption and all the jobs are going to be automated away. Obviously, that's a narrative that we tend to hear in some places in the country more than others. And so I'm
yeah.
very interested in having a little bit of a geo strategy. And we're spending time in hubs like North Carolina, that I just mentioned, Georgia, Tennessee, Utah, Colorado. All of those are geos where there's big corporate centers traditionally, depending on the market, like Tennessee, obviously, a huge healthcare hub, where the companies want innovation. They are going to need it. They don't have enough humans to continue doing the work that they do, but they want it to work. They want a clear use case with a demonstrable ROI that can be calculated, computed very quickly with a payback period that's pretty short. And so less next shiny object, next cool AI tool, more this works and this accomplishes that purpose for that particular value. I'm very excited to spend time in geos where that's the case. And I think investing outside of the coast is an emerging strategy for us that we'll double down on over the next few years.
Yeah, I mean, couldn't agree more. Especially also today, every founder comes to you saying AI powered, AI enabled, right? But why do you need AI? Are you solving a pain point and is AI making it efficient? Or you are trying to use AI and trying to build something that maybe it's not the current need for customers, right? So definitely focusing on labor shortage and where there is a real problem is going to really help in terms of the future workforce, right? So couldn't agree more on that.
Absolutely.
Now, can you share one investment or a founder journey in you launching Full Circle as well that exceeded expectations and one that taught you a difficult lesson?
Okay, with the caveat that I love them all equally, that I don't have favorite children, all that stuff. So I have a few founders in the portfolio that started building a consumer-based business. So direct to consumer, very hard. Historically, there's not a lot of investors who are particularly in love with direct to consumer models. But one in particular,
Yeah,
Julia Dixon at SAI, it's ESAI.ai, came to me with a very strong point of view. She's a marketer and a brilliant marketer. And came to me with a very strong point of view that she wanted to build a platform for students, high school students, to
mhm,
identify what skills they have, what values they hold, essentially what to put in their college essays in a way that was truly unique to them and helping them find the right college for them. And so, eventually, was there a direct to business play or B2B play? Yes, absolutely. But she was very adamant that starting to aggregate a number of students, critical mass of students, and really understanding building the database and the algorithm behind it was critical. And she said, "Look, this is what I'm building. I understand this is hard. I know this is how to build this business, and this is why." And she was very strong point of view on that. Went on Shark Tank, had a brilliant, brilliant episode on Shark Tank. Highly recommend you check it out. And so she has every step of the way validated this is what I'm doing, and this is more importantly how I'm going about it and why. And she's continued to really deliver on what she said she would do, and it has been really impressive to watch. Lessons learned, I would say the biggest lesson learned so far, and like it hasn't been 20 years either, but is that when founders have plan B, generally speaking, it tends to work out a little bit less favorably for everyone. And by that I mean, no shade on consulting or banking jobs. I was a product of that type of career early on myself. If a founder can just as easily go back to Goldman or McKinsey, this is true in, you're going to ask about cycles. This was true in the 2020 to 2022 period. There was a lot of
yeah,
capital in the market and a lot of companies and founders that sort of tried their hand at entrepreneurship without being fully dedicated to it, and having too much almost of a safety net and a plan B. And so
yeah,
I have integrated that question into my due diligence as to like, well, what if this doesn't work? And you can tell often that there's a big difference between the founder has at least a couple of plans in their back pocket versus the ones who are like, I don't understand the question. I'm like, okay. And so yeah, that's a lens that I now bring to my due diligence, that has been helpful in trying to separate the two types of founders, so to say.
yeah. And you rightly also mentioned about the multiple economic cycles, especially we've all seen a lot of risks and crises over time. Now, founders also, right? So sometimes when they come and say, okay, I have a plan B or plan C, that's different from someone who's truly passionate, especially when it comes from their own personal journey or lived experience. It
Yes.
makes a lot of difference, right? Now, with this perspective, has your risk and de-risking of the investments changed over time, or has it kind of remained the same through different economic cycles?
Um, I I think it has sharpened over time, has remained largely the same, though I will say that with the current AI hype cycle, nobody
Mm,
really knows where we are in the cycle, whether it's early innings or not. I think most people would agree it's early innings. I love asking this question of why you, of course, why this? You were talking about founder market fit, critical to our process. I want to understand why you're building this thing. This is, as I tell founders, this is not a get rich fast plan. So why are you doing this to yourself? Why are you building a startup of all the things that you could do with your time and talent?
yeah,
And the why now has become a more important question. And this is all around what makes this possible now that it wasn't possible as of even 3 or 6 months ago. Like I really look to understand. And this is partially for defensibility or gauging how easy it is to build. It has been a long time since I've seen a pre-product company, which should fall into the pre-seed bucket. It's quote unquote so easy to now if I put a product or come to me with a little bit of something, it has become very hard to buy into any sort of product defensibility. If there was ever such a thing, it has gone out the window now. And so, the why is this now the right time to build this and why are you the team to build it? Very specifically, it is helpful. And yes, some of it is AI enabled, but I want to know very specifically where you're applying it and how that makes this very unique and a solution that not no other, but a solution that's truly being built for unique reasons that are unique to you that you can particularly execute on well. So that why now I think has become more prominent of a question in our diligence process.
yeah. And why now and why you? Right? There
Yes,
could be a lot of great ideas, but then execution matters. Otherwise, the idea is not going anywhere.
absolutely.
Yeah, yeah. And we've spoken quite a lot about AI. Maybe this is my last question on AI. Where are you seeing meaningful transformation where AI is reshaping work? What do you talk about or focus more on these days?
Yes. So I've talked about Skillmaker. Maybe I'll tell you a little bit more about what they're doing. Just absolutely brilliant. So what they do is they train auto technicians. They have an exclusive with Napa Auto Shops. It's the white and blue logo. And so what they do
Mm,
is they leverage VR and mixed reality to very specifically assess the skills that a technician might have, whether they're actually really expert technicians and have been in the trade for a long time or brand new out of school or have even not gone to school, right, for it. They can assess them via a VR solution, put the VR headset on, and they can assess exactly the skills that you have and train you on the ones that you don't have to fill that gap. Within 35 days, you can be in an auto shop, right, as an active technician. For every technician seat that is left unfilled for an auto shop, that's about 120 K worth of parts that they're not selling, right? So back to that concept of where's the ROI, what is the use case, how specifically is the technology being applied? Well, in this case, that's very clear, right? You have a technician that can start working in your shop within 35 days. Brilliant. In their case, they're leveraging AI, of course, for delivering the content, but also ingesting it and all that training material can be created very quickly. So we go back to the regulatory side of things for a moment. Historically, the proxy for making sure that someone could safely fix a car was they've gone to school for 2 years. Well, that's a terrible proxy for evaluating whether someone can fix my car safely or not. And so instead, you have a solution where because of the mixed reality component, you can actually assess whether someone can fix a car well or not. Brilliant application. Obviously, lots of economic mobility and a huge labor shortage there as well. So it fit a lot of the or checked a lot of the boxes that we're looking to check, and is one example of brilliant application of AI and some of the things that we're investing behind.
Yeah, I'm seeing quite a lot of areas where training, especially in areas where there is shortage, use
Mhm.
of virtual reality, right? So it's really useful to give practical applications and maybe kind of a hands-on training so that you can get them into the workforce much faster. And the more you gain experience, the more you are reliable in the workforce versus having a 2 year degree makes you reliable, right?
Yeah,
So
100%.
yeah, yeah, no, definitely. Now, for emerging founders and aspiring investors, especially those that are outside traditional networks,
Mhm.
what's the most practical path into venture and early stage ecosystems today?
Mhm. I would say to keep in mind to always be a bearer of gift, right? So it's
Mm,
really easy to outreach to people. I strongly dislike the "Can I pick your brain for, 15-minute coffee?" I do not want
Yeah.
anyone to pick my brain, that sounds terrible. Be specific in your ask and come with a gift. Could just say, "Hey, spend some time on your website, super love the thesis. Here's a founder I was talking to recently in a company that I thought would be interesting to you. Am I right or not? And if not, help me filter so I can send you more deals." Interesting.
Yeah.
Now you have my
Right.
interest, right? Um, I would say that from a standpoint of, landing a job, right, from a pragmatic, expand the horizon to, yeah, VC funds, of course, but there's also a lot of they're harder to find, but, there's also a lot of family offices who do amazing work where you will have, such an opportunity to build a portfolio, and they're often, shorter on staff, and so you'll have greater
Yeah.
responsibilities right away. I would expand the aperture on what you look at and not look so much for, like, brand name, funds, like, keep an eye on the new funds that are coming out, that are being announced in tech publications. Some of them might be a little bit under the radar, but they're tremendously under-resourced, trust me. And so they would really much welcome, someone who's willing to do some work in a meaningful way and perhaps a little bit of a different, maybe a fractional capacity, maybe a non full time. I don't love the word fractional, but capacity. And so try to be flexible in terms of how you want to build the portfolio of work that best positions you for eventually where you want to get to. And you may not get everything right away, but over time, you'll chip at building the experience that's helpful and attractive to a fund or wherever you want to land.
Yeah, I mean, same thing as what we spoke about founder investor relationship. Don't treat it like a transaction. Try to add value, give something, get something, but also maintain the long term relationship, right? So that's kind of the art of networking that's kind of lost these days. But yeah, I totally agree. I don't like the pick my brain concept also. So yeah, no, glad that we could talk about that. I know we are kind of coming up time. I just wanted to quickly check in. Is there anything else you'd like to share with our audience before we wrap up? How can people get in touch with you?
Yeah. No, I would say, we're truly in front of a transformational economic transition time. I write about that a lot. And it's time to really move the conversation away from what we read in the media, because we all know what, clickbait looks like, from a very binary sort of like, is this job destruction or job constructive? Like, let's move past this debate, into really thinking where the technology can most be applied. Whether it's literally and geographically and physically, to more sort of conceptually. But I think there's a lot of opportunity ahead of us, and it's almost like the COVID time where back when I launched Full Circle, like let's not lose that window of opportunity. Let's not let it close without us making meaningful changes that are foundational for generation of workers moving forward. I'm not hard to find. This is one of my first tests with founders. It's, if you're desperate to get my email after I spoke on a panel, trust me, it's not that hard. But yes, I have a form on my website if founders want to pitch me opportunities. I'm very transparent there. There's a huge FAQ and emails and all sorts of information and contact info for us. So yeah, be eager to learn from anyone who's building in and around the spaces that we're excited to continue to invest in.
That's a very optimistic note to close the discussion for today. There's a lot of economic transition and opportunity, so pay attention, right? Ignore the noise and hype. So thanks so much, Virginie, for taking time talking to us today.
Absolutely. Thanks for having me.
Thank you, and let's stay in touch. Bye bye.